Tesla's stock has been on a roll since the S&P indices announced that it'll include the car maker to the benchmark index. Cathie Wood from ARK Investment, who's a long-term Tesla bull, mentioned multiple times that Tesla is highly undervalued and its stock is underestimated even after the rally last year. Cathie added 130,000 Tesla shares to 3 of ARK Invest ETFs recently. The ARK Innovation ETF bought 89,447 Tesla shares, while the ARK Next Generation Internet ETF added 29,508 Tesla stocks, and the ARK Autonomous Technology and Robotics ETF added 13,173 shares. Founder, CEO, and CIO of the asset management company, Cathie Wood, explained that ARK's confidence in Tesla has increased as it does more research. As we've done research on what ride-sharing potentially could add, it could limit the risk significantly. It's a much more profitable business than electric vehicles, she told Bob Pisani during an interview on ETF Edge. In its Big Ideas 2021 report, ARK calculated that Elon Musk's Robotaxi fleet could generate more than $1 trillion in annual operating earnings by 2030. At the core of Tesla's autonomous strategy is the development of the Robotaxi fleet and its autopilot and FSD software. The EV automaker released its full self-driving beta late last year, which is capable of driving on inner-city streets. FSD beta testers have been very vocal about their experiences with the software, often commenting that they see rapid improvements within short intervals. Although Tesla has made tremendous leaps forward with its FSD beta, there is some support for the company to launch its ride-hailing service with drivers behind the wheel. Even though there is some debate at Tesla whether or not they should launch a human-driven ride-hailing network, it would be a very good bridge, we think, to their autonomous strategy, and we think they will decide to do that, Wood said, expressing some of ARK's general thoughts on the subject. Some Tesla owners seem to agree with ARK Invest's opinions about the Robotaxi fleet. Tesla may be slowly making its way toward ARK Invest's Golden Goose scenario, which involves a $22,000 price target pre-split. At the beginning of 2020, ARK Invest realized its updated Tesla valuation based on new research it had collected at the time. ARK analysts described 10 different scenarios Tesla could take leading up to 2024 and gave each one a price target. Tesla seems to be on track to hit the scenario ARK Invest labeled the high-functioning EV company, which has a price target of $3,400. Keep in mind that ARK released these estimates before Tesla announced the stock split. In this scenario, Tesla manages to lower costs and build factories efficiently, but doesn't launch its autonomous network. Tesla has managed to reduce costs further this year and could continue to do so in the coming years. In the third quarter earnings call, CFO Zachary Kirkhorn stated that Tesla would continue to reduce manufacturing and operational costs in the future. We're also seeing benefits from the ongoing upward trend of locally built and delivered cars, which has increased from under 50% at the beginning of last year to over 70% most recently, which is a core component of our cost reduction strategy, he added. Gigafactory Shanghai showed that Tesla could build factories efficiently. Tesla China has been an integral part of the company's profitable quarters this year. The construction of Giga Berlin and Giga Texas are not moving at quite the same speed as Giga Shanghai. However, Tesla has stated that the construction of Gigafactory Berlin and Texas are on schedule and could still start production by 2021. Tesla seems to have checked off the two factors under ARK Invest, the high-functioning EV company scenario that warranted a $3,400 price target. After this scenario, Tesla would have to tackle autonomy. ARK analysts split the 10 scenario into two categories: no autonomous and autonomous. The difference between Tesla achieving autonomy and failing at it significantly affects its price target. ARK's price target jumps from $3,400, the highest in the no autonomous category, to $15,000, which is the lowest price target in the autonomous category. It seems that Tesla's Golden Goose scenario hinges on the success of full self-driving. The EV automaker released FSD beta last month, and it showed massive improvements. Tesla still has a long way to go before it can successfully launch an autonomous network, but FSD beta seems to be a step in the right direction. ARC's research and modeling suggest that three key independent variables are critical to understanding Tesla's potential. Gross margins. Will Tesla's cost of manufacturing vehicles continue to fall in line with Wright's law? If so, what will be the average selling price of Tesla's vehicles? Capital efficiency. What is Tesla's cost per unit to build new production capacity? Autonomous capability. Can Tesla launch a fully autonomous taxi service successfully? The gross margins are the key to Tesla's viability and value. In the fourth quarter of 2019, Tesla reported auto gross margins of 20.9%, excluding regulatory credits. Based on Wright's law and expressed in ARC's model, Tesla's auto gross margins could approach 40% in 2024, though they're unlikely to increase in a straight line as new models launch and production scales. Wright's law has forecast cost declines successfully in more than 60 technologies, ranging from solar power to televisions and from semiconductors to ovens. As shown below, Tesla's Model 3 already has demonstrated cost declines in line with Wright's law. The auto industry has scaled in line with the cost declines predicted by Wright's law for more than a century. As shown, Ford's costs have tracked the declines predicted by Wright's law since 1903. While Ford's costs appear to have stabilized, Tesla's costs should continue to decline during the next 5 years because the internal combustion engine is a technology far more mature than is the lithium-ion battery. A mature technology seems to stop declining in cost because of how long it takes to double production from a large base. Globally, automakers have manufactured roughly 5.4 million EVs to date, less than 1% of the 2.6 billion ICE vehicles ever produced. Even if the production of ICE vehicles were to stabilize at roughly 90 million vehicles annually, a cumulative doubling would take 29 years, much longer than the roughly 1 to 2 years likely for a cumulative doubling in EV production. In addition to our Wright's law analysis for vehicle production costs, ARC's model drops the average selling price for EVs selling at higher volumes. In the bull case, ARC estimates that Tesla will be able to attain only 15 to 20% of the addressable market for each model. At their peak, the combined sales of the Model S and X commanded roughly 20% of the premium vehicle segment. ARC's high-end gross margin scenario. Despite the assumption of a steep decline in average selling prices, if costs were to fall in line with Wright's law, ARC's model suggests that Tesla's auto gross margin could approach 40% in the next 5 years. ARC's low-end gross margin scenario. If its costs do not conform to Wright's law, Tesla's gross margins should increase modestly to 25% by 2024, consistent with the average margins for luxury automakers when adjusted for ownership of distribution and service centers. As shown, Daimler and BMW have gross margins of roughly 19%, while national car dealerships have gross margins of roughly 15%, a third of which typically is from services. Capital efficiency. Capital efficiency sparks and accelerates the Tesla flywheel. If expanding capacity is prohibitively expensive, then the cumulative doubling of production, necessary to lower costs, generate cash, and reinvest in expanding production, becomes uneconomic. If Tesla were to be capital efficient, then it could expand production rapidly and affordably, lowering unit costs, increasing returns on invested capital, generating cash for future factories, and attracting more capital. ARC assumes that Tesla will be more capital efficient than traditional automakers. The amount of capital required to produce a car powered by an internal combustion engine in the U.S. has been rising steadily. In the last 5 years or so, the auto industry has invested more than $14,000 in fixed assets for every car produced per year. With a fraction of the moving parts, electric vehicles should be manufactured much more efficiently than gas-powered cars. Indeed, Ford and other automakers have suggested that EVs could be produced at 50% of the capital investment necessary for gas-powered vehicles. A straightforward calculation, 50% of $14,000, suggests that an EV factory could be built for $7,000 per unit volume of capacity. ARC's high-end capital efficiency scenario. In their capital-efficient case, Tesla will be able to build factories for $11,000 per unit volume of capacity. For context, Tesla confirmed that $1.6 billion in financing was necessary for its Shanghai factory, which will have an initial capacity of 150,000 vehicles. If $1.6 billion were to net 150,000 vehicles, the cost per unit of initial capacity would be roughly $10,700 before increasing productivity. ARK's low-end capital efficiency scenario. According to their model, if it were not capital efficient, Tesla's cost per unit of capacity would be $16,000, or $2,000 higher than the gas-powered auto industry average today. Autonomous execution. A fully autonomous taxi network could break the mold of a traditional automotive manufacturer's business model completely. Tesla could shift from a model of one-time transactions at hardware-like margins to a model of recurring transactions at software-like margins, charging passengers per mile and taking a platform fee. ARK's high-end autonomous execution scenario. Initially, Tesla could set rates comparable to the $2.50 per mile that Uber and Lyft charge today, dropping them to $1 per mile in 2023. They model that Tesla will take a 50% cut of gross revenues from autonomous taxi networks, much higher than the 20 to 30% cut that Uber and Lyft enjoy today. Based on the additional convenience, improved safety, and cost savings, they also assume that its autonomous taxi service will begin in 2021, 1 year after Elon Musk has predicted the service will be available, regulatory approval permitting, with just 2% of eligible Tesla vehicles on the network in its first year. ARK's low-end autonomous execution scenario. If an autonomous taxi network never launches, clearly it will generate no revenues. As shown, the full picture of the flywheel should become clear. An autonomous taxi network should provide Tesla with capital to invest in factories to produce more vehicles, which should lower production costs and expand Tesla's autonomous fleet. Overall, Tesla stock may slowly be making its way toward ARK's price target as people are finally realizing the true potential of Tesla brand and Tesla future products, and plans look good for the company. With Giga Berlin and Giga Texas set to start production this year, the delivery numbers from 2022 will be huge. Thanks for watching.